Banks seem like safe places for your paycheck. You deposit money, watch it grow, and trust the bank to keep it secure. Your parents and teachers may have told you that saving in a bank is the wise thing to do. It feels comforting to see a balance on your screen. But banking has changed over the years, and much of what we believe about it is based on myths. In this video, we reveal 5 secrets that banks would rather you did not know. Each secret shows how banks make money using your money and how you can fight back. Understanding these secrets can help you protect your cash, make smarter decisions, and build a better future. Stay with us until the end because awareness is the first step toward freedom from financial traps. Secret 1. Banks use your money to make money. When you place cash into a savings or current account, you become a lender to the bank, even if you don't realize it. Modern banks operate under something called fractional reserve banking. This means they hold only a small part of all deposits in cash and lend out the rest. Imagine 10 people each deposit $2,000. On paper, the bank has $20,000. The bank might keep $2,000 in reserve and lend out $18,000. Your balance still shows up in your account, but the bank has already put most of that money to work by issuing mortgages, car loans, student loans, and business credit. Lending is profitable because the bank pays you a small interest rate and charges borrowers a higher rate. If you earn 1% on your deposit and the bank lends at 5%, the bank pockets the 4% difference. Multiply that by millions of customers and the profits are huge. Banks also create money through this process. When a loan is made, a new deposit appears in the borrower's account, even though the original deposit remains. This expands the money supply. Central banks set reserve requirements and interest rates that influence how much banks can lend. But rules have been relaxed in recent years. In 2020, the reserve requirement for transaction accounts was cut to 0, allowing banks to lend nearly all deposits. Banks invest some deposits in government bonds, corporate debt, and even complex financial products. They earn returns while you receive a tiny fraction. If many customers suddenly withdraw money, the bank might struggle because funds are tied up in loans and investments. Deposit insurance protects your savings up to a certain limit if a bank fails, but it does not stop banks from using your money while you sleep. Knowing that banks are businesses designed to make profits helps you see why they behave the way they do, and why you must manage your relationship with them wisely. Remember, deposit insurance covers only $250,000 per deposit or per bank. Spread large sums across banks to stay within the limit. Secret 2. Your savings lose value because of inflation and low interest. Money kept in a traditional savings account at a big bank doesn't just sit still. It quietly loses purchasing power every day. Inflation measures how much prices rise over time. When inflation is around 3% and your bank pays 0.01%, your money's buying power drops by nearly 3% each year. It is like leaving a block of ice in the sun. It melts slowly at first, but eventually there is almost nothing left. Consider an example. You deposit $10,000 in a standard savings account paying 1/100%. After a year, you earn about $1. During that same year, if prices rise by 3%, the goods that cost $10,000 now cost $10,300. Even though your balance looks the same, you can afford less. Extend this over 5 years and the gap widens. People often leave money in big banks out of habit, or because they believe large banks are safer. Yet big banks pay the lowest rates. Many well-known banks pay 0.01% on savings. At that rate, a $10,000 deposit earns a single dollar a year. By contrast, smaller banks and online banks offer high-yield savings accounts paying 4 to 5%. At 4.5%, your $10,000 would earn about $450 in a year. That is hundreds more than a large bank would pay and is enough to keep up with inflation. The national average savings rate is around 0.4%, still below inflation, but high-yield accounts beat the average. These accounts are just as safe as those at big banks because deposits are insured up to $250,000 per institution. Opening an account online takes only a few minutes and can be linked to your main account. The lesson is clear. Don't let inertia cost you money. Shop around for a better rate. Move your savings to a high-yield account to protect your buying power and make your money work for you. Certificates of deposit lock your money for a term but pay more. Combine a high-yield account with a certificate to keep some money liquid while earning extra. Secret 3. Credit card debt traps you with high interest. While banks pay almost nothing on your savings, they charge very high rates on credit cards. The median credit card interest rate in August 2025 was about 24%. Some cards for people with lower credit scores can exceed 30%. These rates are thousands of times higher than what big banks pay on deposits. The gap between what banks pay and what they charge is a major source of profit for them. Credit card interest is calculated on your daily balance and compounds if you don't pay in full. If you carry a balance of $3,000 on a card with a 24% rate, You could pay over $700 in interest in a year. Pay only the minimum, and most of your payment goes to interest, barely reducing the principal. Banks design the monthly bill to highlight the minimum amount due, encouraging you to pay less and stay in debt longer. They also entice you with reward points and cash back, but these benefits are small compared to the cost of carrying a balance. Your credit score affects the rate you get. Those with excellent credit may pay lower rates, while those with fair or poor credit pay the highest. Credit card rates move with the prime rate set by central banks, but issuers add their own margin. Even when central banks cut rates, card rates often remain high because banks adjust slowly or not at all. Total revolving credit in the United States has climbed past $1.3 trillion, and delinquency rates have doubled since 2021, showing more households are leaning on high-cost debt. To avoid the trap, pay your credit card balance in full each month. If you already carry debt, explore balance transfer offers with 0% introductory rates or a personal loan with a lower rate to consolidate. Build your credit score by paying on time and keeping your utilization low. Use budgeting tools to track spending and treat your card like a debit card. Remember that credit cards are convenient for payments and can offer useful rewards, but they are designed to keep you paying interest. Use them wisely so you benefit without becoming a source of profit for the bank. Secret 4. Banks make billions from hidden fees. Beyond credit card interest, banks collect many small charges that add up to big profits. Overdraft fees are a major example. When you spend more than the balance in your current account, the bank may cover the payment and charge you a fee. For years, the typical overdraft fee was around $35 per incident. A small purchase like a coffee could result in a fee that is many times the cost of the coffee. Households that paid overdraft fees spent an average of $225 each year. Big banks such as Wells Fargo and Chase each collected about $1 billion annually from overdraft and non-sufficient funds fees. Some banks even rearranged transactions to create more overdrafts, processing large payments first to drain the account and then charging multiple fees for smaller payments. In early 2025, the Consumer Financial Protection Bureau proposed a rule to cap most overdraft fees at $5. The rule aims to return billions to consumers by reducing surprise charges and forcing banks to be more transparent. Under this rule, banks can still offer overdraft lines of credit with clear pricing, but they can no longer treat small overdrafts as a high-cost loan. The rule applies only to large banks with more than $10 billion in assets, so fees may persist at smaller institutions. Overdraft charges are not the only fees to watch. Banks also impose monthly maintenance fees if your balance falls below a certain level, charge for using cash machines outside their network, add foreign transaction fees on purchases abroad, charge for wire transfers, and sometimes even for paper bills. While each fee may seem minor, together they can drain hundreds from your account each year. The solution is to choose accounts with no monthly fees, link your current and savings accounts to cover accidental overdrafts, use cash machines in your bank's network, and read the account terms carefully. Many credit unions and online banks offer accounts with no overdraft fees and reimburse cash machine charges. Being aware of fee structures and adjusting your banking habits can keep more money in your pocket. Secret 5. The wealthy get cheap loans. Not all customers are treated equally by banks. People who have significant assets often receive special lending terms. Wealthy clients can borrow against stocks, mutual funds, real estate, or even cash value life insurance at rates far below what an average person pays on a credit card or personal loan. These arrangements are known as securities-based lines of credit or margin loans. When you have a large investment portfolio, you can pledge it as collateral and access a flexible credit line. The more you pledge, the lower your interest rate. Banks use these products to keep rich clients' money in-house and to earn interest from them. A securities-based credit line offers liquidity without forcing the investor to sell assets. Borrowers can use the funds for many purposes, such as buying property, funding a business, paying a large tax bill, or seizing an investment opportunity. Because the loan is secured by investments, the interest rate is usually just a few percentage points above the prime rate. Wealthy borrowers can negotiate even better terms by pledging more assets. Banks are willing to charge less because there is less risk of loss and because they want to maintain the relationship. There are also tax benefits. Debt is not taxed like income. When someone sells appreciated stock, they owe capital gains tax. If they borrow against the stock instead, they receive cash without triggering a sale and sometimes can deduct the interest. This helps explain why some billionaires borrow against their shares rather than sell them. They then invest the borrowed money in assets that earn higher returns. For example, borrowing at 5% and investing in a fund that returns 8% yields a 3% gain using other people's money. This practice is called arbitrage. Banks also extend other forms of low-cost credit to wealthy clients, such as home equity lines of credit and loans against life insurance policies. Meanwhile, regular customers rely on credit cards and personal loans at rates near or above 20%. Recognizing this double standard helps explain why wealth gaps persist. If you own assets like a home or an investment account, you may qualify for a lower rate by using them as collateral. However, these strategies carry risk. If the value of your investments falls, the bank can demand additional collateral or sell your assets. Rising interest rates can also increase the cost of borrowing. Always seek professional advice before using collateral to borrow. The conclusion is, banks play a crucial role in the economy, but they are driven by profit. They use your deposits to fund loans, pay you little, charge high interest on credit cards, collect fees, and offer the best terms to those with the most assets. Understanding these practices empowers you to take control of your finances. Move your savings to a high-yield account that keeps up with inflation. Keep only what you need for daily spending in a current account. Pay off credit card balances each month, and if you have debt, look for lower rate options. Avoid or minimize fees by choosing the right bank, linking accounts, setting alerts, and reading the fine print. If you have assets, explore secured borrowing carefully and use the funds to invest in things that grow in value or produce income, not to support unsustainable spending. Build an emergency fund so that you are not forced to rely on high-interest debt in a crisis. Educate yourself about financial products and ask questions when talking to bank staff. They must tell you the terms, but only you can decide what is right for you. Share this video with friends and family who may not know these secrets. The more people understand how banks work, the better they can protect themselves. Like and subscribe to Frankie Finance for clear, practical advice that helps you build a sound financial mindset. Awareness leads to action, and action leads to freedom. Thank you for watching.